I'm joined today by David Rosenberg, Head of Liquid Performing Credit and Co-Portfolio Manager at Oaktree. David is among the incredible investors sharing insights at the Family Office Investment Forum today. Welcome, David. It's great to have you with us.
Yeah, thanks for having me.
How would you compare the value proposition of credit versus equities in the current environment?
Well, I think we're in a unique period right now where, in my biased opinion, credit actually provides a superior opportunity to equities, which is very rare. Usually, when I compare credit to equities, I do it on a risk-adjusted basis because credit is structurally disadvantaged to equities. It's asymmetric to the downside. Equities have unlimited upside. But right now, we've got a PE multiple on the S&P in the low 20s. And if you look, JP Morgan did this study. You go back to 1985. Every time the PE multiple of the S&P is above 20, the forward 10-year returns are between +2 and -2 since 1985. And so you're in a period where, at the very least, you can say equities are very overvalued. I like to say you need robust growth just for prices to stay where they are. And I think we're in an economy where it's not crazy to think things might start to slow down. But with credit, I don't need growth. I just need companies to generate enough cash to pay me back. And if they do that, I get a contractual return in the 7 to 8% range. And I think that contractual return is going to rival what you can get out of equities going forward.
What factors are most important for successfully investing in sub-investment grade credit?
Well, really, in the end of the day, it all comes down to defaults. It's very simple. Credit, when you buy credit, you have a contract. I give a company money. They have to pay me interest, and when the debt matures, they have to give me the money back. That's the deal. Your return is set by the yield. The only thing that can ruin that is the company defaults and then they don't pay. And so in the end of the day, it really comes down to the investors who are the best at credit are the ones who avoid those defaults. And so we say credit is less about winning and more about not losing.
And to what do you attribute the rise in popularity of multi-asset credit?
I think it's when you think about conversations I've had with clients recently, I find that it has dramatically shifted. It used to be I would sit down and try and convince people they should have income in their portfolio, but the income was very low because rates were very low. And so at 4 to 5% yields, nobody wanted that income and they went and bought equities. Now I find the conversation has shifted from people saying, okay, I want income, but what kind of credit and when? Those are the two most common questions I get from clients these days. And the beauty of multi-asset credit is you don't have to decide what kind of credit. This is everything we have in one place. And you don't have to decide when, because we regularly meet as a team to decide how we want to change the asset allocation. And the thing about credit is the quicker you buy, the quicker you start clipping a coupon. And so the power of getting in early is very important. And so I think that is really what's driving a lot of people to multi-asset credit today.
And where are you finding the best pockets of value across credit markets?
I think there's a few areas right now that we find very interesting. Right now, CLO debt, I think, is very attractive, especially double B CLO debt, where you can get a double-digit return relative to the risk you're taking. I think that is attractive. Real estate debt, we're finding to be very interesting. It's a good diversifier for portfolios. Loan-to-values are very attractive there. So the yield may be similar to high yield, but with less risk. And so that's kind of the art of this business. People always think about opportunities based on the yield you can earn without talking about the risk. The risk is way more important, in my opinion. And so that's another area. Europe is an area that we're finding attractive for both bonds and loans. So that's a market. Europe is a smaller market than the US, and so it's less liquid. So you generally will get a pickup to go from the US to Europe just to compensate you for the less liquidity. Right now, that pickup is abnormally high. And whenever you're getting paid more than you typically are getting paid for an opportunity, that's something that we will take advantage of.
And where are you seeing risks forming across credit markets?
You know, the risks right now, there's a few things going on. I think one is if we have an economy that feels like it's starting to slow down, then there's, on average, I think the credit market actually is very healthy, but every market has tails. So there's certainly going to be certain credits, especially the ones that are very heavily involved in leverage buyout activity where leverage is very high, that need either growth to continue or need rates to go back down for those balance sheets to work. Those are areas that we're being very cautious on right now. I think geopolitically, there's a lot going on that the market seems to be very, very comfortable turning a blind eye to. If you look at wars going on, you look at tariffs and the impact that that may have on the economy. In the US, you have a deficit that we're going to have to fund. There's a lot of things to worry about that the market seems to not worry about. And so that's the other big risk. I think right now there's this mentality, and it's not uncommon to, whenever things get risky, people just go back in the US to the Fed put. And I don't have to worry because the Fed will show up and save the day. And I think that you're getting to the point where that is very much priced into the market. If things get bad, the Fed will show up to save the day. And usually that's when we get a little more cautious. When people don't worry is a good time to worry. I think that, Warren Buffett always says you have to wait for the tide to go out to see who's been swimming without a swimsuit. And I think that's when we want to be a little more cautious.
Thank you, David. We're going to need to leave it there and get back to the forum. I really appreciate you sharing your expertise with us today and for being part of Global Investment Institute's Family Office Investment Forum.
Thanks for having me.